I now have the distinct pleasure of introducing our esteemed guest speaker for the day, Mark Mahaney, Managing Director with RBC Capital Markets. I've had the opportunity to hear Mark speak many times, and I have no doubt many of you attending will walk away from this webinar with some pertinent investment ideas and a better understanding of the internet sector. Since beginning to cover internet stocks in 1998, Mark has been ranked by institutional investors one of the top analysts for the internet sector for the past 14 years, as one of the top 3 analysts for 12 of those 14 years, and as the #1 analyst for 5 of those years. He has also been ranked #1 in the Greenwich Institutional Investor Poll for the internet sector and named the #1 earnings estimator and stock picker in the internet retail segment by the Financial Times and StarMine. A sincere thank you, Mark, for joining us today. Mark, the floor is yours.
Okay. All righty. Let's see here. I'm going to try to share my screen, and I'm going to go through the slides. All right. Can you see me? Are we good here?
We are good, Mark.
Great. All right, I'm going to go through these this presentation, 7 key trends and 6 top picks. You can always cut me off, interrupt me whenever you like. I'm going to do my best to go through these quickly and hopefully put a little entertainment in here too. We cover, and there's 6 of us in San Francisco, we cover about 40 stocks in the internet space. They go from A to Z, Amazon to Zillow. The large cap names that we spend most of our time on are the FANG U stocks, so Facebook, Amazon, Netflix, Google, Uber, but also Lyft, Spotify, Booking, Expedia, Alibaba, et cetera, a series of mid-small cap names. I'm going to go through kind of some of the key themes we're looking at, and then I'll wind up or I'll wrap up with our top picks. 7 key themes in internet space. So we've unfortunately gone through this dramatic crisis this last year, since late February. And it's created both winners and losers. And that's a crass way to talk about a pandemic, but it's true. So there are 3 sectors that have surprisingly or unsurprisingly benefited from the COVID crisis. First is online retail. We have seen an acceleration in consumer demand for purchasing products online. Offline retail options have been either shuttered, closed, limited, only partially reopened. So people still need to purchase products. They purchase them online. And then you've also had a shutdown in a lot of travel spend and a shutdown in a lot of entertainment spend. So there's a lot of consumer discretionary dollars that have flowed to retail, flowed to online retail. Online retail has been a structural winner, major winner from the COVID crisis. And think about names like Amazon, eBay, Etsy, Chewy. Web presence has been the second vertical that's really benefited from the COVID crisis. And web presence, I mean companies, digital tools companies, web presence companies, businesses that help individuals, organizations, nonprofits, corporations, SMBs get on the internet, sell on the internet. So I'm talking about Shopify, Wix, GoDaddy, those 3 names. Those have been structural winners, big winners from the COVID crisis. Third are the streaming companies, and here I only really mean one, which is Netflix. Out-of-home entertainment options, limited, crippled, shut down, and still, I think I just saw 2 days ago, one of the biggest cinema chains in the world decided to reshutter until next year. With that happening, and key things like James Bond being pushed out till next year, there's just a dearth of out-of-home entertainment options, including live sports, although that's coming back modestly. So that's left in-home streaming as a clear beneficiary, and you had record sub ads, number of new subs going to Netflix. So those are the 3 categories that have been winners from the COVID crisis to date. And the stocks have largely reflected that too. We've had upwards estimates revisions across the street for the Amazons, the Shopifys, and the Netflix of the world, and their share prices have gone up accordingly. You've also had some underperforming sectors or some real COVID losers, 3 sectors in particular. So we had 3 winners and we got 3 losers now. The 3 losing categories are online travel. Clearly, we've materially cut back, drastically cut back on travel, flights, hotels, et cetera. Second is ride sharing. You know, the key drivers of ride sharing for names like Uber and Lyft have been commutes, rides to social outings, rides to the airport and back. And all three of those categories have been dramatically undermined by COVID. We've seen a recovery, but it's been glacially gradual. So you've had negative revisions. Estimates have come down for both of these categories, online travel and ride sharing. Third is live events. And there's just a few companies in there, but clearly there are very few live events. So companies like Eventbrite have really had seen some of the worst dislocation in terms of their revenue. I mean, it's gotten so bad, online travel companies actually had greater than 100% decline in bookings. Mathematically, that's not possible. You can't decline more than 100%, but you can if you include in cancellations. And so that's what happened with the online travel companies. The worst quarter in online travel history is how the chairman of Expedia described it, and he was right. They hope it's the worst quarter. I do too. All right. Third theme that we're looking at here is then there are these internet advertising names, and frankly, they've been in the losers category in terms of all of them have had negative estimates revisions except for Amazon for its advertising revenue. All of them saw a sharp deceleration or decline in ad revenue in the June quarter because brand advertisers pulled campaigns. There were certain verticals like travel, like hospitality, that just cut out all advertising. I remember during the worst of it in late March, doing a basic Google search for hotels in Las Vegas. And for the first time in the history of Google, there were no advertisers bidding on that term. So that just told you just how bad the environment was. Anyway, this sector has been dramatically negatively impacted, but not equally. And there have been some models that have proven themselves to be highly resistant, not surprisingly, Facebook and Google up there, also Roku, whereas other sectors, other companies like Pinterest and Lending Tree were really negatively impacted by the COVID environment. So the theme here, or the point here, is that internet advertising names have been negatively impacted, but not equally. Fourth theme, regulatory risk is definitely rising. Okay, yesterday the House subcommittee of the Judiciary Committee on Anti-Competitive Practices issued a couple of reports. There was the majority report, there was a somewhat dissenting minority report, there's another minority report coming out. So this is top of mind. It's exactly why Facebook and Google are underperforming the market today. One of the great experiments in democracy, I'm exaggerating, occurred earlier this year when these four individuals on the screen, the CEOs of Google, Amazon, Facebook, and Apple, were forced to endure 5 hours of grilling by elected representatives. Democracy won, big tech nothing. And it was actually a very good event. I don't think those four individuals have been interrupted as much in their lives as they were during those congressional testimonies. I did watch all 5 hours of it. You can go to YouTube and watch it at 2x speed, so you don't have to spend 5 hours. But it was fascinating. But what I looked at the end of it was there was a bipartisan consensus. I mean, it was Democratic and Republican congressmen going after these CEO execs. I think 99% of the questions were critical / hostile. So it says something about how public sentiment in the U.S. has changed when it comes to big tech companies and their alleged abuse of power. And there's no question these platforms are dramatic in scale and power and influence. Whether they're abusing that or not, that's an open debate. And I'm not a lawyer, so I don't have a good opinion on that. Actually, I do, but we don't need to get into it. All right, theme number 5. We've become less constructive on Google in part because one of the big themes this year has been this acceleration in online retail growth, and it doesn't seem like Google has fully participated in that. It certainly hasn't. And there's two things that are going on. There's kind of a pincer movement in online retail. You get the rise of Amazon. So if people are going straight to Amazon to search for things to purchase, that's a lost revenue opportunity for Google. We're also seeing the rise of social commerce, which is one of the most interesting trends, and I'll click on this a little bit later, where people are actually purchasing products on Facebook, on Instagram, and Pinterest. And maybe think about your own social media usage and whether you've seen ads that look like product ads and whether you've purchased anything on those. It's impulse shopping, but it's highly targeted impulse shopping. And we think this is actually, this year is actually really creating the impetus, the boost for social commerce. And the unfortunate reality for Google is that if there's e-commerce that occurs on Facebook, Instagram, Pinterest site, Google gets no tax on that. If it occurs on Amazon's side, Amazon is actually one of the biggest buyers of Google search advertising, but there's none of that Google search revenue if it's not on social commerce. So that's a concern of ours at the margin. We still have a buy on Google, but we have become, of the major tech platforms, is probably our least favorite stock. Let me put it that way. All righty. Theme 6, and this just revolves from what I just talked about, this targeted impulse purchase. TIP is the new acronym. We did see this a dramatic increase in usage of Facebook Marketplace, higher percentage of Instagram and Pinterest users that actually purchase products on those sites. So it is something we're tracking both from the marketer side, the merchant side, and from the user side. That's the new acronym. This is probably those last couple of slides, like the biggest negative trend from the year is rising regulatory threats focus. The biggest positive trend is or the biggest new market opportunity trend is the rise of social commerce. I think Facebook's a great derivative play off that. And then finally, innovation remains strong across the internet sector. I think product development, you want to create market cap, you do great product development, and that's really what wins. And it's in a lot of different areas. Instagram Reels, I think, is an interesting product. The Michelle Obama podcast, I just meant that as an example of Spotify's really leaned heavily into podcasting, and podcasting has really taken off. Joe Rogan is an extremely popular podcaster. We're just seeing something of a media shift amongst US consumers, amongst global consumers, and really an embrace of podcasting as a kind of a new emerging medium. So we've seen some really nice innovation here on the part of Spotify. Wix has had some really nice product innovation in terms of their extended e-commerce solution. There are clearly if you were a physical store retailer without a digital presence, without a website, your retail revenues in the months of March, April, and May were pretty much zero. But if you had a web presence, you had a chance to retain your customers, maybe attract new ones, and continue to sell. And then this number 4 example here is Casa de las Flores, if I pronounced that correctly. And what Netflix has done, one of the most interesting areas of innovation I've seen is in terms of developing local language originals. We see the most popular shows for Netflix in India and in Mexico are shows that are actually created in those markets, directed in those markets, produced in those markets, acted in those markets, funded by Netflix. Anyway, I think that's one of the most interesting innovations that we've seen in the space. So that's theme number 7, innovation remains strong across the sector. I try to provide a few examples. All right, let's get to the top picks. And in large cap, I'm going to give 3 picks. Uber, Facebook, and Amazon. And I think about this as if you're going to put new money to work now, where would you put it to work? So, and this is a mix of names here. Uber is a recovery stock or a vaccine stock. It was my top pick at the beginning of the year. Looked beautiful. It was doing great outperformance. And then COVID came and really kneecapped Uber's ride-sharing business. That business went into 80% year-over-year declines. Pushed out profitability, really a tremendously negative event for them. But if I'm going to look out 12 to 18 months and I'm going to look for a dislocated, high quality, large cap internet stock, I'm sticking with Uber. Just like Facebook was that dislocated, high quality stock 2 years ago, just in the face of all of the controversy around Cambridge Analytica and the elections. Just like Netflix last year was a highly dislocated, but high quality large cap internet stock, and there was the dislocation related to them missing sub numbers and a Disney Death Star that was about to be launched called Disney Plus. But those were good assets, and if you were willing to stand in there, step in there, and buy those dislocated stocks, you got a double in a 12-month time frame. I'm making a pitch. Uber. Uber is the business prior to COVID. I think will return to post-COVID. I think we'll return to prior to COVID levels. I think we'll be able to grow. I think they'll be able to grow the ride-sharing business 20 to 30% year over year, 60% gross margins. The Eats business has been structurally benefited, like some other companies, from this from the COVID crisis. We clearly all have done more food delivery during the COVID crisis than we did prior. And I think you're going to change fundamentally some human habits. So there is part of the business that's actually done reasonably well. Most of the business is done poorly, but we think within 12 months, we'll start seeing a really full recovery in ride sharing. A major event is coming up November 3rd with these elections, including the Proposition 22 ballot in California. All the polls I've seen indicate that Uber and Lyft will win this, that the yes vote will win. If it doesn't, that'll be a negative. It's a material either way, but I think the probability is that that passes. I think Uber as a company reaches break even next year, end of next year, and we think we'll see a material re-rating in the stock. It'll go from 2 times price to sales to 4 times price to sales. If you just look at it on a numbers basis, it should be trading material. It should trade in a materially higher multiple if you look at comps. Facebook is the number 2 pick in the group. We think we're going to see a V-shaped recovery in its online advertising revenue, and we think they benefit from political advertising. And we think there'll be a great derivative play off of social commerce. It's also still just a great business model. Even in a COVID-induced depression, they're still going to do recession. They're still going to do 35% plus operating margins. They generate a lot of cash. They'll start returning more of that to shareholders at the margin. And there's just a lot of good innovation going on at the company in terms of social commerce, Facebook Marketplace, and Instagram Reels. Third pick is Amazon. And I'll do this briefly. If there's one company that's most benefited from the COVID crisis, it's Amazon, because online retail is accelerated. Amazon fully participates. Amazon's ad business hasn't decelerated at all. Because its core customer base are online retailers. We think cloud computing is probably a structural winner from the COVID crisis. And fourth, we did a very detailed report recently on AMZL, which is Amazon Logistics. Amazon this year is expanding its distribution center capacity by 50%. They're buying a lot of what are called delivery stations close to dense population areas, urban areas, suburban areas. And so that means they're buying a lot of commercial real estate, and as luck would have it, that commercial real estate's become a lot less expensive in the last 6 months. So Amazon's really won 4 ways through this COVID crisis. We think this is probably the single best asset that I cover, long term. But I particularly like the near term setup. I think there's going to be, I think they're going to have accelerated market share gains in this fourth quarter. My guess is that they print record operating profits this fourth quarter. So those are our top 3 picks: Uber, Facebook, and Amazon. And finally, last slide, small cap, mid to small cap. Roku is actually pretty big market cap, 20 billion, but Stitch Fix, Roku, and J2 Global, those are our 3 top picks in mid small cap. Stitch Fix is a kind of fashion online apparel company that also I think could see a doubling of its multiple. It's trading at 1 times price to sales. I think an asset like that should trade at 2 or 3 times price to sales. They need a recovery in their business post-COVID. I think that will happen. There's a lot of interesting innovation going on there in terms of new functionality called direct buy. Second is Roku. That's our number 2 pick. It's a great play off of streaming, but ad-supported streaming. So, and I think about half the market is paid subscription, and half the market is ad-supported streaming. I think they're the single best way to play that. It's still early stage in terms of the amount of revenue that they're generating. They're doing less than $1 billion in revenue against a TAM that's probably at least 70 billion. So there's a lot of runway for them. And J2 Global is actually a name I don't know that well. My colleague Shweta Kajuria is the lead analyst on it, but we did decide to put that in their relatively recent offering, relatively recent research coverage for us. We thought there was an interesting dislocated stock opportunity there. So that's it. You got our themes, 7 themes, and our 6 top picks. Again, large cap, we're going Uber, Facebook, Amazon. Small cap, we're going Stitch Fix, Roku, and J2. And that's all I got.
Great. Thank you so much, Mark. We appreciate the presentation. There's definitely some very beneficial information in there. But now I think we'll get to what everyone is looking for, which is the Q&A section. We had a lot of people sending questions ahead of time, so we'll start with those. And if you have any other questions that you would like answered, there's still time. Please enter those into the Q&A section whenever you get a chance. So, Mark, let's get started. The first question that came through is there a bubble of the current internet and online businesses? Are they overvalued, and what could cause a burst or a repricing of those companies?
No, well, I don't think there's a bubble. I can think of a lot of different thoughts on this. You know, I've been covering internet stocks since '98. So I think I know what a bubble is. And we certainly experienced it back then with very large market caps and almost no earnings. There's now more cash that's held on the balance sheets of the large cap internet stocks than there was market cap at the peak of the dot-com bubble. So the business models have clearly been proven. They're large market opportunities. These companies, we've not all of them. There's a few of these companies that have really shown excellent execution and vision over time, and some business models that really generate an enormous amount of profits. Amazon, Facebook, Google, especially the latter two. So no, I don't think there's a bubble. We had a big rally in the shares in August. I thought was a little odd. I think the sell-off we had in September was probably warranted. It was probably a healthy correction. So that's the setup. There are some things that I do worry about. I focus on over the next, call it 3 to 6 months. One is that we are almost certainly going to have. Oh no, we're not. There's a distinct possibility that we have a change in administration, and the Biden administration has clearly said they're going to revert to pre-Trump administration corporate tax rates. So that will clip earnings at these companies. There's also a move by the Biden campaign to reduce the tax shield associated with international profits. And these companies have a lot of revenue and profits in overseas markets. And then there's potential for capital gains taxes to be increased. And I'm a little less clear on that. But the logic has been capital gains taxes are going up. People may well lock in their gains and sell their winners. And there's no question that big tech has been a big winner in 2020. So I guess I could see a couple of tax technical reasons why you'd want to be a little bit cautious near term on some of these tech internet names. But I'll, at the end of the day, still lead with fundamentals. And I think, and I especially look at a name like Amazon. By the way, of all the big tech companies out there, Apple, Microsoft, whoever you want to throw in there, Tesla, Google, there's only one of them that's had dramatic upwards estimates revisions this year. That's Amazon. So if you want to, if I like to see stocks move up, but I like to see them move up on upwards estimates revisions, and that also tells me that the move up is more sustainable. So I think these are large franchises. I think there's increased regulatory risk. I think there's near-term tax technical risk. But I think the overall fundamental thesis on a name and the ability of these names to maintain premium growth rates, I think that's pretty well locked and loaded for the foreseeable future.
Great, thank you. The next question comes in from Marshall. How do we justify extremely high price over earnings like Zoom, even looking out 18 months?
Yeah, I don't cover Zoom, but I do cover Shopify, so I'll swing on that one. And there's also Netflix, which trades at a very high PE multiple. And I do have some comfort stocks. I am pitching Facebook, and that Facebook trades at 23 times earnings, 24 times earnings for what I think is sustainable 20% plus earnings growth. So it trades at a premium to the market, but for earnings growth that I think is at least double that of the market. So I'm okay paying that kind of premium. You go to a Netflix where the PE multiple is much higher, or to a Shopify where you don't yet have positive GAAP earnings. And yeah, that's much more challenging. Essentially what the market is doing, and if I'm recommending the stocks, what I'm doing is essentially saying that I think they can maintain premium revenue growth, or even hyper revenue growth. So premium revenue growth for me is 20% or greater. Hyper revenue growth is 30% or greater, and that they can ramp up profitability margins over time such that that terminal value in the DCF will support today's stock price. So it's almost like a VC bet. And so you have to believe that the long-term market opportunity is really large. This is the winner, either Shopify in e-commerce enablement, or Netflix in global video streaming. You have to kind of make the bet that it's a large market. That's the winner, and their business model will one day be able to generate substantial amounts of free cash flow. So you have to get all three of those bets right. I know that's tricky, and I've made plenty of mistakes here, but that's the answer to your question. You can wait. What I find is the market's going to discount these stocks and going to be willing to look forward, a couple of years, and they're going to do that in part because people have realized how big some of these markets can be, and they wanted to. You could have waited a long time to wait for Amazon to start generating substantial amounts of free cash flow if you'd started off with the assumption that it's just retailing. Like there's nothing fundamentally flawed about Amazon's business model, that through the right type of scale and good execution means they shouldn't be able to kick off free cash flow. If you'd kind of made that bet and just really stuck on how big is the market and how well are they executing against that market in terms of market share, you would have bought Amazon well before you could talk about a reasonable free cash flow multiple or a reasonable PE multiple. But that makes them also more speculative, also a lot riskier, because if the value is all in the terminal value, changes in interest rates, that stock is going to be a lot more volatile than one that's clearly trading at a reasonable, 15 to 25 multiple for premium growth asset with, good healthy margins that have already been proven.
We had two questions come in regarding the next frontier for growth and opportunity and which sector that would fall in. So the two thrown out there were the 5G space and also AI. Any thoughts on both of those, or is there another sector where you see growth blooming?
I'm going to punt on 5G. My colleague Jonathan Atkin would have better ideas as to how to invest off that. I just don't know the infrastructure bets off that. I would make the point that kind of like with internet stocks and broadband, they don't have to pay for it, but they certainly benefited from the rollout of broadband 15 to 20 years ago. And 5G, anything that increases wireless speeds, the reliability of wireless communications, the speed of wireless communications is good for the apps that people use wireless services and devices to get access to, your Facebooks, your Googles, your Amazons, your Netflix, et cetera. And then on the AI side, yeah, I think these companies, a handful of these companies have probably invested more, hired more, built more around AI than any other companies in the world. I mean, there's maybe 5 companies that have really at the forefront, cutting edge forefront of AI. I'd probably put Microsoft in there. Definitely would put Google in there. Definitely Google. I think Facebook to some extent. I think Amazon is in there. And then I think there's 1 or 2 companies in China. One of them could be Baidu and possibly Alibaba. So there's a handful of these names that have really invested an enormous amount. And it's hard for us to really sometimes appreciate the positive impact of AI, because there's no line in the P&L. There's no revenue segment called AI. It's just that it's made these processes faster and faster, more personalized. It's made your search results better over time. It's made your news feed more relevant, more personalized to you. It's made the ads that are thrown in front of you more relevant to you. So we've seen the application of AI, and then there's some big, open field running areas for AI in terms of health science that Google is taking some interesting cuts at. And especially in terms of autonomous vehicle, that may be the mother of all or the father of all AI projects out there. I've been waiting for that. I think we're all been waiting for that. I think that's going to be the most obvious sign of the deployment of AI.
Okay, so you touched briefly on this when you were discussing the teleconference that Zuckerberg and Bezos and the other heads had over the summer. So why hasn't there been a tech company regulation in the market? And do you think that we'll see a similar situation with tech that we did in 2008 with the banks?
I want to go backwards. Well, 2008, the banks had to get bailed out. Tech doesn't need to get bailed out. Tech can bail out most of the other sectors. They've got so much cash. And then, but will there be heightened? Yeah, but there was a backlash against banks, I think. I think that, yeah, there was, and there was more regulation against banks. And I'm sorry, I'm no expert on that. I'm just trying to recall personal history. And then I think about, we're seeing a backlash against tech. Again, that congressional hearing, it was Democrats and Republicans were vying against each other to see who could throw in the sharpest dart against Bezos or against Zuckerberg. That was a bipartisan can of whoop ass that Congress opened up on big tech. So, and Congress is, those people get paid to try to understand and reflect public opinion, and they're pretty good at it. Those representatives, and that's their job too. So anyway, I think we do really have an issue. I read this congressional report, or I've read reports of the congressional report. It's 450 pages. It came out last night, so no, I haven't read it all yet. But we will work through it. that I want us to just remember a few things. Like, there's no question these have become very powerful platforms, and absolutely they need to be regulated and watched. And we should probably be ready. We should be ready to throw some speeding tickets against these companies, because we can come up with examples of where they really strong-armed some suppliers. Google, the EU has done a pretty good job of finding some of the faults in these, and particularly in terms of Google. So regulators should absolutely doing their job. If you're regulating, I don't know why you wouldn't start with big tech. These companies are very powerful platforms. But I just want us to remember, in the grand scheme of things, 3 points. One is that these companies have been phenomenal for consumers. The value proposition of an Amazon, a Google, a Facebook to consumers, they have immeasurably positively impacted almost all consumers' lives. Secondly, the ground to really look at these companies is, are they stifling innovation? Keep in mind that these companies have been great centers of innovation over the last 2 decades as I've watched them. And I love the fact that they're making big bets on the future. They could be just riding out their core businesses. Google could just ride as a search business, maybe with a little YouTube. They don't have to get necessarily into the hardware business. There's no particular reason for them to invest. It's not obvious to me that they invest in autonomous vehicles. But what I think is great about Google, and that's actually great for innovation as a whole, these companies are willing to make 5 and 10-year bets, either on virtual reality becoming the next computing platform, maybe not, but Facebook's making that bet, or that there really will be an autonomous vehicle world and saving millions of lives a year in terms of reduction in traffic fatalities. That's, I like to see the innovate. So these companies have been centers of innovation. So I think those are 2 extremely important points. I guess the third one is, as a U.S. citizen, I think it's benefited the U.S. that leading companies in search, social media, and retail, and streaming entertainment, and ride sharing are all U.S. companies. I think that value accrues back to us. And then the final thing is, have they really stifled innovation amongst other companies? And that's really the place to look at them carefully at. And I think there are very good reasons to study them for that. And again, I think there are some situations. I think this is a speeding ticket zone, though. This is not putting people in prison. I butchered that analogy, but I think you know what I mean. And I didn't go to law school, so everything I said is very, very conjectural. Sorry.
Thank you, Mark. What are the top 5 most critical factors you examine before choosing a stock to invest in?
Oh, I love that question. I've thought about this a lot, and so I sometimes use a cheap answer to that question. I call the 4M framework: markets, business models, management teams, and competitive moats. And then I guess if I was going to do a 5th one, well, somewhere along the way I'd bring in valuation, so that could be multiple. So that's your. I guess that would be your 5. And of those, and I've talked about this before and written about this. I think kind of the quality of the management team probably trumps everything else. And then it's the market opportunity. So management team and market opportunity are probably the 2 most important things. And it's a hard thing to really screen management teams. But I look for things like willingness to look long-term as public companies, willingness to not have their strategies dictated by quarterly margins or quarterly revenue targets. I'd like to see companies largely be able to stick to their guidance and show that they have some reasonable visibility, and then they put in the work to show people that. I appreciate all those elements, but management teams are the really great management teams show the ability to succeed in multiple markets. Usually have a lot of consistency to them, can peer around corners and see changes. And I can come up with a bunch of examples where I've seen Amazon, Facebook, Netflix. Netflix is a wonderful example. There's a company that was started as a DVD by mail business. And then that co-founder actually created a business that destroyed the DVD by mail business. You rarely see management team being willing to destroy their own their core business. But Netflix did a wonderful job of that. So management teams are really important in market opportunity. And I do think that oftentimes really good companies can expand their TAMs, expand their total addressable markets. Those are far and away the 2 most important things. Business models. I mean, you've had a wonderful business model in Google, high margin, business, generate a lot of free cash flow. Amazon, which with a very low margin retail business, actually has created more market cap than Google has. So I'm not sure business model matters too much. And in competitive moats, that other M, I kind of think it's really good management teams that determine really good competitive moats. But there also are situations where you look at industries where the incumbents are entrenched and offer a bad service, and that creates the opportunity for these companies to come in. So that moats are sometimes reflective of competition, and sometimes competition is weak. So anyway, since you asked me, those are the 5 factors I would think about. But in order of priority, I'd go management, the skill of the quality of the management team, the size of the market opportunity, and then I'd probably go the competitive moats that the company has built. Least of those 4 important would be the actual business model, the capital intensity or the margins of it. And then only fifth, would I focus on the multiple or the valuation. I generally think that the really good assets, if you can find an asset that's growing at a premium rate, 30% earnings CAGR for 10 years, that's a rarity. But when you find those things, I think valuation largely takes care of itself.
Thank you, Mark. I know that was a question that we got a few times, so we appreciate you taking the time to explain that answer. Another question came through: which 5 tech stocks should far outpace the indexes over the next 5 years and/or 10 years?
Oh, okay. So you're also asking about some stocks that I just don't cover: Microsoft and Apple, and I guess Tesla and Salesforce and Zoom. So all I can really talk about usefully is the internet stocks. And I think the single best assets there would be, I probably stick with the FANG-U acronym. There's just been this acronym FANG for I think it was coined 3 or 4 years ago, maybe 5 years ago: Facebook, Amazon, Netflix, Google. I just changed that to go FANG-U, to add in Uber, like FANG-U very much. If you're asking for 5 stocks for 5 years, it's FANG-U.
Great. Now we have a lot of questions coming through, broken down into individual companies. So we'll start moving through those. The first one is: given the tension between the US and China, what are your thoughts on Alibaba moving forward?
We like Alibaba. It's not one of our top 5 stocks. Maybe it should be. Maybe we actually should put Baba in there instead of Google. I got to think about that. So obviously we are pretty constructive on Baba. They have such a nice position in the China market in terms of cloud computing, much more importantly in terms of retail advertising. They seem to be a nice combination of a couple of different companies, U.S. companies in China, but with clearly distinct Chinese characteristics. So those tensions don't help Baba. But then again, they have very little. They have relatively limited exposure to the US market. They don't really sell here directly. They do help Chinese exporters sell. I wonder, though, as an exercise, who is involved with more Chinese retailers and manufacturers going into the US? Is it Alibaba or is it Amazon? Because there's a large percentage of those Amazon third-party sellers that are China-based. So anyway, I generally think that US-China trade tensions will create some headline volatility around Baba shares, but I don't think it impacts Baba's fundamentals, because Baba's fundamentals are, I don't know, 90% plus intra-China, Chinese vendors, Chinese consumers. So they're largely sheltered from US-Chinese trade and technology tensions.
Palantir recently went public. Do you have opinion at all on this company?
I'm sorry, I don't cover it.
Fair enough. I think you spoke on this briefly earlier, but if you could elaborate, what do you see is the future for Amazon?
Amazon has 3 core businesses now: retail, cloud, and advertising. I think they can all 3 maintain premium or hyper growth for the next 5 years. And then the question is, what about new areas that Amazon's going into? Well, they're making a huge investment into logistics. I don't think that's a standalone business to take on FedEx, or UPS, at least not in the next 5 to 10 years, but I think it helps their core business. I think Amazon gets more into business solutions. We did a detailed report on that earlier this year. They're making a major push into groceries, so that's really kind of their retail offering, but that is a big new area of retail that they're going into. And there's a big push they're making in the more international markets. We did a deep dive report on what we call the 5. They've launched into 5 large markets in the last 5 years: India, Brazil, Mexico, Australia. I think Turkey was the 5th one. And anyway, so I think they're gonna try to accelerate the flywheels in the international markets. That's what I think about as the future of Amazon.
Okay. Can you speak at all to the upcoming elections and what may happen depending on who is in the White House and how that will affect the internet markets?
Leave aside the issue of rising corporate tax rates or a reversion to corporate tax rates. And our strategist, Lori Calvasina, has done a lot more work on this than I have. That's not necessarily internet specific or tech specific. So leave aside those issues. I actually think that the differences between the 2 campaigns are relatively muted. And the key issues would be things like gig economy regulation, skilled immigration policies, R&D investments, and I guess the last and really the most important one would be antitrust regulation. And you would typically have said that a Democratic administration would be much tougher on large companies, on conglomerates, on potential monopolies. But and we just had this Democratic subcommittee report of 450 pages, and I've got 448 pages still to read. That I thought was pretty negative towards big tech. It was clearly very negative towards big tech. But we've got an administration now, a Republican administration, that's any day, any hour now filing suit against Google. Its DOJ is filing suit against Google, and its FTC may file suit against Facebook. So it's almost like I don't see that much of a difference. This is a bipartisan issue now. So I don't know if that answers your question. We did do a report on this. We called it Tech Eye on the election. And it really does seem to me that the differences are pretty nuanced between the 2 administrations, with the exception of corporate tax rates and then possibly personal tax rates, but those aren't specific to tech.
Okay, we've had a couple questions come in on your take on the ETFs or the SPAC stocks. What your thoughts were on those?
I'm sorry, I don't have anything useful on that. Just not something I've studied in detail.
Fair enough. This may go along the lines of Fang Yu, but which 5 companies are best for buy and hold for 5+ years?
Fang Yu. And I guess I should mention BABA in there. So that's 6 stocks. So I'll still stick with Fang Yu. I can't figure out if I take the G out and put the B in, I can't, what do I, if somebody comes up with a good acronym there, maybe I'll switch that. So Fang, is that Fang? Well, Fan Boo. I'm sorry. I'm going to stick with Fang Yu. I got to think about whether Fan Boo I got to think about that one.
Sounds good. I'm sure we'll get a lot of suggestions coming through after the presentation today. We'll make sure to pass them along.
Fan Boo.
Yeah. This is a question that comes in from Trent. What are the top 2 potential negative factors you're keeping an eye on that could cause you to divert to a defensive market outlook strategy?
Yeah. Okay. And I think about 3 broad challenges for these companies. I think about competition, regulation, and maturity. There's a lot of biggest competitive risk for Amazon is the rise of Microsoft Azure. Biggest competitive risk for Google is the fact that Amazon retail is increasingly attracting more and more of core search activity. The biggest competitive risk for Facebook, I'd say, is probably TikTok. And the biggest competitive risk for a Netflix would be Disney. So all of them face competitive risk. If we saw rise in competitive risk activity on a company by company issue, that could make us less constructive, which it has done on Google. Maturity, it's just, there is a limit to your ability to, if you can find large assets like this that are growing 20% year over year, you stick with them, because that's a sign usually of how big the market opportunity is and how well the assets are being run. So I'm less worried about maturity risk now. Regulatory risk, though, is probably, of those three, is probably the biggest one. It's certainly what's in the headlines. And I doubt that there's a breakup of these assets, and I can come up with scenarios in which a spin-off of certain assets would actually be highly accretive to shareholders. But I think forced breakups are never a good thing. And I just think that the regulatory scrutiny probably is not a good thing for these companies. At times, it may well be a good thing for society, though, which is the job of the regulators. That's what I got.
Thank you. How are the current interest rates affecting the internet sector?
Oh, I think low interest rates, and we've had low interest rates for quite some time, are good for growth stocks. End of statement. I think that's true. I think there's some mathematical reasons behind that. The lower the interest rate, the less that you discount the terminal value in the DCF, and therefore the more valuable the asset is. And growth stocks generally have more of their value in the terminal value. So that's kind of the math behind that. But I generally think that growth stocks or technology stocks that are growing, technology stocks that aren't growing trade at a discount to the market. And that was eBay prior to COVID. And my guess is that'll be eBay post-COVID too. But shoot, I just, I'm sorry. The basic point is these stocks get a premium because they can generate premium growth. GDP globally is, 2-3%, something like that. And if you can find an asset that organically is growing 10x that at 20% top line or 30% top line, a couple of these companies are doing it. That's why they deserve a premium multiple. The question is, how long can they sustain it? And then that gets back to the question of, well, you can sustain high growth if you're chasing a really large market opportunity and you have a really good management team that knows how to execute against that. So anyway, that's why, low interest rates have clearly been part of the boost behind growth and tech stocks. And I don't know, as far as I can tell, we're going to have low interest rates for quite some time.
Okay. What are your thoughts on cybersecurity stocks like Palo Alto Networks and FireEye?
I'm sorry, I don't cover them, so I don't have a useful opinion. I apologize.
Fair enough. So we have a couple questions on VIX. This one is, I've been watching the VIX all over the place with regard to options activity. Do you buy into the theory that quote unquote Robinhood day traders are driving volatility?
Work from home is wonderful in most ways. One of my sons has just joined me. He's waiting for me to, help prepare him breakfast. So I apologize about that, but he says hello. And then the other thing is VIX. I'm sorry, I don't have anything useful on VIX. I should have started off by saying that. It's not something I've studied. We would have a technical analyst who would have a useful opinion on that. I don't. I apologize.
Sounds good. Well, hello to your son from everyone here at Patina and on the call today. We always love having guests on. Do we have time for one more question?
Yes.
Okay. So for the last question, if you want to expand on it a little bit, could you please speak to volatility concerns related to everything internet going forward?
Well, I don't know. Volatility is kind of, high beta stocks. Tech and high beta usually go together, not always. And after they become well-established companies like Facebook and Google, you see less volatility. Amazon, you've seen less volatility. So I guess sometimes the real great wealth creation is when they go from highly volatile to not volatile, because if they become not volatile, that means that people have become more confident in them, and hopefully confident that they will continue to grow rather than confident that they're heading to zero. So I guess that's sort of one thing I think about it. I guess I just want to leave you with one thought, which is, I think there's, but my job as an analyst is to really to find really high quality assets, and that's most of my job. I think that's 75% of my job. I think Then the other 25% is find them when they're at a discount. And that's when you can really make the most money in this space. But you can make money trading medium, low quality assets. But I sort of feel like there's a greater safety factor if you can stick with the high quality assets, because they can trade off, and Netflix has traded off, and Facebook has had big trade-offs. Amazon hasn't had a real correction in a while, and so that means it probably is going to have one, maybe related to regulation. But if you can find these assets and find them when they're really dislocated, that's when you kind of really wade in and you buy those stocks. And so I don't know if we've got a great track record or not. Again, I made plenty of stock picking mistakes. But I sort of felt strongly about that with Facebook 2 years ago. I know there was all this debate over Cambridge Analytica and Facebook's role in the elections, but at the end of the day, they still own the two largest social media assets in the world, the two largest messaging applications in the world. This was a high margin business, visionary, long-term focused management team, maybe had a political tinea, but I'm not buying them for their political advice. I'm buying them for their ability to generate positive free cash flow. So anyway, that's my strategy, and it worked with Facebook. And last year with Netflix, you had to kind of make a bet that people wouldn't leave Netflix just for Disney, and you had to make a bet that they did have pricing power, and everybody screws up a quarter once in a while. But generally, the trends and the move towards streaming was kind of a long-term 5 to 10-year trend, and there was plenty of runway. If you were willing to make that bet, you had a really great opportunity to make an outsized return. And I'll just end up with my number one pitch again, Uber. I think it's the most dislocated, high-quality internet company. I just think that once we're beyond COVID, once we're mobile again, I think people will become increasingly comfortable using Uber or ride sharing for commutes, for social outings, for trips to the airport. I think they fundamentally displace the taxi industry, the chauffeur industry. It's the value proposition I think is compelling to users. The value proposition can be very compelling to drivers too. And it's a nice business model that can generate pretty high, healthy margins over time. And Uber doesn't have to pay any Amazon tax. They don't have to pay any Google tax. It's wonderful to be in a business where you really, once the name of your company really defines the industry, they're the Uber of. It's kind of like Google. You don't search for something, you often Google it. When a company reaches that level, it's part of the lucky lexicon, is the expression I once used. Then they don't have to spend money on sales and marketing. Everybody knows who Uber is, and they know about the company worldwide. So it's got a global market opportunity. I think it's going to have very healthy free cash flow generation that the market's very uncertain about. But I think that's over the next 5 years, we're going to see it in spades. And they also have this great synergies with this food delivery business. It's a dislocated stock. I know that, looking at the multiple that it's trading at. And I think it's a very high quality asset, and there's a lot of debate over that. So that's my top pick here. Is it going to be volatile? Yes. You have this November 3rd, Proposition 22 in California. That's extremely important. I think they really need to get a yes on that. The stock can still work if they get voted against. That's a no vote. But I think it looks to me like the probability is that they get the yes vote, and then that'll be just the first of, I think, 3 or 4 catalysts over the next 12 months. And when we're talking again a year from now, the range in the stock is kind of like 30 on the downside, but it's like 60 on the upside. Like the risk reward here, I think it's very attractive. So that's my pitch answer to your last question. Thank you for your time today.
Mark, thank you so much. Really appreciate you joining us today. It's been wonderful.
Thank you.
Absolutely. Thank you so much for being on today, Mark. I know I had a lot of my questions answered. I'm sure everyone on the call today did as well. We hope to have you on again. Thank you to RBC Wealth Management for putting this together. Jonas and Kyle are awesome advisors who work with Patina Nation members all the time. Their contact information is up on the screen, so please feel free to reach out and contact them to learn more about what RBC can do for you. Again, thank you everyone for being on the call today. Big thanks to Mark. We really appreciated you being on. I will leave this information up on the screen for a few minutes. So if anybody wants to jot down an email address or phone number, feel free to do so. But other than that, everyone have a great rest of your afternoon. Thank you.
This has been a presentation of the Patina Nation. To watch more content like this or for more information, please visit us online at www.patinanation.com.